Hi, this is Jim Cunningham. We're going to talk about how to avoid and defer capital gains taxes. So, a very important topic, very common. A lot of people don't like capital gains taxes. A lot of people don't like taxes at all. But we're going to talk about how to avoid capital gains taxes and defer them. So, hey, if avoiding is great, deferring is second best. Pay, don't pay now, pay later. Pay later with inflated dollars. Pay later in different tax brackets. We'll talk about that. But if you're watching this, you might be thinking, yeah, I'm looking for ways to minimize my capital gains tax liability. Well, right out of the gate, the thing that we typically tell our clients is they say, I'm selling a building. I want to avoid capital gains tax. Have you spoken with your tax advisor, your CPA, your team? Have you spoken with your A team? Do you even have a tax liability, right? Do you have other capital losses? Do you have a loss carryover? Do you have enough itemized deductions to offset your tax liability? So, and then even if you do the planning, what about AMT? That's alternative minimum tax. That's something that can bite you. So this is absolutely something before you sign the papers to sell the asset or whatever it is. You want to check with your advisors, and you may want to check with your advisors years before you're thinking about doing this, because this is done typically on an annual basis. And so if you sell that thing in a given year, you might be doing some other things in that year that increase your overall tax burden. So I would put this definitely in the planning category. So the tax implications obviously can be significant. We're going to cover today, we have a lot to cover, a lot of material: tax loss harvesting, tax advantaged accounts. We're going to talk about some charitable strategies, opportunity zones, 1031 exchanges, low income strategies, meaning, in years where you have low income, as well as installment sales. So I'm a partner at Cunningham Legal. I've got 30 years of experience as a lawyer. I'm a certified specialist in estate planning, trust and probate law, a real estate broker, securities and insurance licensed, and a pilot. So this is very important. This is not legal advice. This is not tax advice. In other words, do not, just because I'm talking, when I say you, there's no attorney-client relationship. I'm not giving you advice. I'm saying this so you understand, right? So that you have a better understanding and can learn. Don't watch this and go and do a bunch of stuff. You absolutely want to do this with your advisors, the CPA, the attorney, financial advisor, real estate professional, whoever it might be. Well, how do capital gains taxes work? What are these? And why is it different than income tax? Why do you even draw a distinction? Well, the capital gains tax is the tax on the difference between your cost basis and the net sales price. So what is cost basis? That's a very technical term. In this context, we mean it is purchase price, what you paid for the thing, plus improvements, minus depreciation. Okay. So if you buy an investment property and you make an addition, that would be an improvement. And then you have depreciation. And in the United States, depreciation is for residential, it's over a 27.5-year period. And if it's for commercial or industrial or non-residential, it's 39. This is for real estate. So, and you can deduct the expenses of the sale as well. So this is your net sales proceed. And this applies to stocks, bonds, crypto, jewelry, coins. The government has come out and said crypto, by the way, the wash sale rules don't apply to crypto. It's an asset, at least, at the time of this recording. And of course, real estate. So a short-term gain is a gain realized on investments held for less than a full year. So it's very important to pay attention to the timing of a sale. And this is especially true for stocks. So if you have publicly traded securities, a lot of people don't hold real estate for less than a year. I suppose you could. But really what we're talking about here to watch out for, the gotcha, if you will, is on publicly traded securities, so stocks. A long-term gain is a gain realized on assets held for more than a year. And all transactions are tallied during your applicable tax year. So it's very important to pay attention to what happens in a given tax year. Now, if you are a human being, and I suppose only human beings can be watching this, right? If you're a human being, your tax year is January 1 to December 31. If you're a non-human taxpayer, which would be an entity, a corporation, a partnership, you can have a different tax year. So if this is tax that is captured at the corporate level, which might be a C Corp, right? If it's a corporation tax is a C Corp, that is going to be potentially not a calendar year. But again, if you're a human, it's going to be a calendar year. So how do capital gains taxes work? Let's look at an example here. So Ike, boy, I wish I could go back to myself a year ago and say buy NVIDIA. Ike buys 100 shares of NVIDIA on March 1, 2023 at $230 a share for $23,000. On February 29th, 2024, Ike sells his 100 shares of NVIDIA for $790 a share, and it's a gain of $56,000. That $56,000 is subject to a maximum federal rate of $20,720, right? Because he didn't wait a year to sell the stock, all right? So had he sold the 100 shares on March 1, a day later for $800 a share, his gain would have been $57,000 and his maximum tax would have been $11,400, so about half, right? 46% savings. So that is an example of the difference between short-term and long-term gain. Again, I wish I could go back. I think anyone watching this wishes they could go back in time and say, psst, buy NVIDIA. So short-term capital gains are taxed at the federal income tax brackets. And I don't know why the federal government has 7 brackets. I don't know. It's kind of ridiculous, but they do. And it's a graduated tax bracket. So the more you make, the bigger those dollars, as they kind of, you go up higher and higher, the more of those dollars go to the federal government. So the short-term capital gains tax rate is a maximum 20%. And federally, the income tax rate is, at least at the time of this recording, 37%. So a big, big difference. So it pays attention. It matters to pay attention to the timing. So in California, and I'm speaking here, we're in California, right? We help clients in many other states in the United States, but in California, capital gains taxes can be 37.1%. So if you're in Florida and you're complaining about capital gains taxes, be thankful that you are not a California resident, right? Because if you're a California resident, these taxes almost double. I mean, it's kind of nuts. I mean, they go up more than 50%. So 20% federal plus 3.8% net investment income tax. And we're going to cover this in a little bit, but net investment income tax, do not ignore that, all right? Because it's a sneaky little tax that can, if you do some things that push up your overall income, it can be just this additional 3.8% tax. The maximum income tax rate in California, at least today, is 13.3%, and you add all those up and you get the 37.1%. So again, if you buy something for $1 and sell it for $3, that $2 gain is subject to these taxes. Many times a capital gain, realization of a capital gain will push you into net investment income tax. And, 3.8% doesn't sound like a whole lot, but, money's money, right? And it makes sense to be mindful or have mindfulness about when you are selling certain assets. And, it might make sense to spread that gain over a number of tax years, because when you run the numbers and you run the analytics, overall, you're ending up with more money in your pocket. And remember, when that money goes to the U.S. government, you are never seeing it again. When it goes to the state of California, when it's income taxes or capital gains taxes, you are getting nothing in return. When you pay Medicare taxes or Social Security taxes, you are getting something in return. You're getting Medicare coverage. You're getting some type of Social Security benefit in the future. But again, the taxes we're talking about here are the confiscatory taxes. That money's gone. It goes to the government. You never see it again. It's over. So capital gains tax rates in the United States are based on your filing status. If you're single, married, filing jointly, or married, filing separately. This is very important. And if you're watching this, if you're listening to this and can't see it, you might want to take a look at this, because this is very important. If your income is low, your capital gains tax, your federal capital gains tax rate is 0. So, a lot of people, maybe if you stop working when you're 60, and we have a couple of examples on this, when you stop working at 60, you don't have any earned income. You're not hitting your RMDs till 73, your required minimum distribution. You may have a period of time where you don't have any income. Right now, you might have investment income or whatever it might be, but these are years where we see, if somebody says, hey, I'm going to sell my company, or I'm going to sell a piece of property when I'm 60, sometimes it might make sense to defer the payments on those over that decade or so that you're in between 60 and when you start your RMDs, because there's a big freebie in there. You really can minimize this potentially this tax liability by taking advantage of these lower rates. And I put the trust rate on here only to remind people. Now, this is not a living trust. This does not apply to living trust, but this is going to be your non-grantor trust. And so what this means is, so if if you create a trust, and the trust is deemed the taxpayer, the trust itself, then these higher rates kick in at much lower levels, and your maximum rates kick in at income or capital gain of over $15,450. Something important to understand about capital gains taxes. There's been talk about this. There have been proposals about this. There is no adjustment for inflation. And if you're watching this if on video, I put up a Coca-Cola machine. I played golf as a kid. I don't know, a teenager. I was like 13, 14 years old. I'd go to the local golf course. They had a machine that dispensed the recyclable Coca-Cola bottles in the early 80s, and it was 25 cents for a Coke. And you would put the quarter in and you would get that Coke out and you would drink it, and then you would set it in the little basket so the bottle would get recycled. Okay. 25 cents could buy something. I don't even know if people even pick up quarters on the street anymore. All right. People used to buy houses in the San Fernando Valley for $999,000. Why do I know that? Because my grandfather was a surveyor in the San Fernando Valley in the 50s, early 50s, when my mom would ride horses along Ventura Boulevard and Sherman Way. And for those of you who know where that is, not exactly a place you would ride horses today, but back in the day, it was orange groves and just kind of a different world. But stuff has all gone up. All right. So Rich buys Greenacre for $100,000 in 1977, sells it in 2024 for $500,000. The $400,000 gain, by the way, what cost $1 in 1977 costs $5 today. That Coke that's 25 cents is $2 or whatever it is, right? So Rich, when he realizes his capital gain of $400,000 and it has to pay tax on it, he's basically in the same position he was in 1977, right? So when he bought this thing for 100,000, that's now worth 500,000, right? Adjusted for inflation, that has the same purchasing power. But when he sells it and has his $400,000 gain, he has to pay tax on that. So in a sense, the government is taxing. Not only is the government largely pushing inflation on us, they're then taxing, right? So if your assets go up, they've got to be taxed. So this is really a bad deal for a lot of people. So the most common, well, I don't want to say the most common, a common way of avoiding capital gains taxes is to die. So I guess if it's you dying, that's not such a good deal. But I mean, I say this in jest, but it's kind of true, right? If somebody passes away and you inherit that property, then that capital gains tax bill goes away, provided that it's included in your estate, and there aren't some other exceptions. But largely speaking, if a person has an asset that they've owned for a long time, in the example, Rich, if we waited till Rich died and then sold it for 500,000, there's no capital gain. So you get an adjusted cost basis at death. And I'm trying to put this in terms that more inclusive terms for the younger people who are Harry Potter fans. Now, I wasn't much of a Harry Potter fan, but we made up this spell that is cast. You get the adjusted cost basis at death. You wave a magic wand and you say, Donum Haredum. It's weak attempt at humor. Donum Haredum. And what this means is heirs boon. This really is an heirs boon. So people who inherit from an estate, whether it's a trust or a living trust or a probate estate, can get an adjusted cost basis. So imagine somebody passes away, Harry Potter casts the spell, and poof, Abel and Baker, they're married. They own Greenacre as community property. When Abel dies, Greenacre gets a full adjusted cost basis. So Baker can sell this property without paying capital gains tax. So I would say, for many families, so if we're talking about multi-generational family wealth, sometimes it makes sense to wait until somebody dies to sell that asset because the capital gains are gone. So Charlie's single. Another example is Charlie's single and owns Blue Acre. And so when Charlie dies, Delta, Charlie's daughter, inherits Blue Acre with a full adjusted cost basis. Delta can sell that property or start redepreciating the property. So it might make sense to hold assets until death. You do need to check to see whether your state allows for a full adjusted cost basis on the death of one spouse. California is a community property state. Hint, Colorado is not. If you are a Colorado resident and you're married and you say, gee, this sounds great. So when my spouse dies, I'm going to get an adjusted cost basis. No, it's not a community property state. What if you move from California to Colorado? It's a little complicated. You might start losing some community property attributes. You might not. What if you're in Colorado and you say, well, I really like this community property stuff. I want some of that. There are other states where you can create structures to transfer these assets into these structures and get community property treatment. So Lots of multi-state issues going on here, but just because you live in a separate property state does not mean that you can't get this full adjusted cost basis at death. So if you live in a community property state and you're married and you want the adjusted cost basis at death, reach out to us. That's something we can help you with. What about state death taxes? That's a whole other issue. You know, California does not have them per se. Other states do. Washington's a big sneaky one. Washington and Oregon, they started $1 million and $2 million in terms of when they impose death taxes. So you do need to pay attention to that. Tax loss harvesting. What is tax loss harvesting? So if IDA buys 10,000 shares of XYZ in 2018 for $100 a share and 10,000 shares of ABC for $100 a share for a total of $1 million, one stock goes up, the other one goes down. If you sell the winner and sell the loser, it nets out your capital gains tax. So the idea here is you want to, as the year sort of might be coming to a close, and this is a lot of our clients do this in the fourth quarter with their advisors. They look and they see, hey, you know what? I sold some stock in March that went up. Where are the losers in my portfolio that I can sell? All right. So that is loss harvesting. That is tax loss harvesting. Here's why people don't do it enough. And I think somebody even won a Nobel Prize for this. Loss aversion. Humans experience pain twice as strongly as pleasure. So the sting of a loss hurts twice as much as the pleasure of a gain in a stock. So you are more likely potentially to sell that stock and take a gain, less likely to take that loss. And selling a losing stock makes it concrete. It can be emotionally difficult. There's a lot of emotion in there. And I would say if you have assets and investing, emotion is not your friend. Okay. This is just numbers. It's business. Okay. The sunk cost fallacy, investing resources, time, money, whatever it is into a losing venture, simply because you've invested so much, you're less inclined. You know, I've been following that stock. I've been reading their reports and it keeps going down and down and down. I put so much time into this, you know, and then also holding on, thinking that it'll come back. Well, I know, you know, this is just going to come back. Sometimes it's better to cut your loss, take the loss, offset the gain, end up with more money in your pocket, send less money to the government. You know, hope and recency bias. We cling to the hope that the stock will eventually rebound, and we overestimate the chances of a recovery. There's also something called disposition effect, which is a tendency to sell winning stocks too early to lock in your gains and hold on to losing stocks too long. So it's like if loss aversion had a baby with the desire to avoid admitting a bad investment decision, right? So that's the disposition effect, right? Sell the winners early to lock in your gain, but still hold on to those losers. That can really have some negative consequences when it comes to creating wealth. Also, lack of an exit strategy. So if you invest in something without a clear plan to exit the investment, so if the stock falls 10%, I'm out, or whatever it might be, having that predetermined exit strategy can remove that emotional component. Well, we talked about loss harvesting. Let's talk about gain harvesting. What is gain harvesting? Well, gain harvesting, sometimes it makes sense if you have a good idea of what your tax brackets will be in the current year and future years. Sometimes it makes sense to pull the trigger if you're in a lower tax bracket and fill up that tax bracket. So what you're doing is, if you know you're going to liquidate a position of stock and it's going to be liquidated in 5 years, it might make sense to start liquidating it over time. And so this is where you work with a financial advisor, your CPA, your attorney. And sometimes it makes sense to realize a gain sooner rather than later. So Emma, age 65, has a low basis stock portfolio and large IRAs. Emma's income will increase when Emma takes required minimum distributions at age 73. So it might make sense for Emma to sell some stock annually prior to age 73 to take advantage of lower taxes, because when she sells that portfolio and she's in the higher income tax, when she's getting her RMDs from her retirement accounts, the overall tax bill can go up. Low income year strategies. What's a low income year strategy? Well, it's a little bit of like the Emma example. When you're working, your income tends to be higher. And a lot of people retire right around, 60. Some people retire later, some people retire earlier, but we see this in our practice quite a bit. A lot of people, when they're in their 60s, their income is lower. They're traveling, having a great time. It's the go-go retirement years in your 60s. 70s are the slow go. The 80s are the no-go. Once you begin your RMDs, it's a whole new world, right? And what's an RMD? If you've got money in a retirement account, when you hit a certain age, 73, unless it's a Roth or unless it's in a 401k and you're still working, that money's coming out every year, right? And so you're going to have to take out a percentage of that account, whether you want to or not. It's going to go from the left pocket to the right pocket, and you're going to send some money to the government. So the timing of the realization of the capital gain can affect the amount of taxes paid, if any. And this is very important because if your income's low enough, you're not paying any capital gains tax. So very important to pay attention to. Rex retires at age 60 and sells his appreciated stocks annually until his required beginning date at age 73, taking advantage of the lower capital gains tax brackets. We're going to talk about qualified opportunity zones. This is an interesting spin, and there's a kicker in here with a solution that we will be discussing in future webinars with our channel partner, Ascent Wealth Management. But what is a qualified opportunity zone? Well, a qualified opportunity zone was created by the Tax Cuts and Jobs Act, and the qualified opportunity zone is designed to encourage investment in low-income, distressed communities that need funding and development. Now, we can debate whether it actually works or not. I'm not even talking about that. I'm just talking about the investment side and the tax side. So what is the structure? It's common to see a fund structure. So it's not like you're investing in an opportunity zone, but you're typically in some type of a pooled investment. You have to invest your capital gains within 180 days of the sale, of the liquidity event. You sell your company, you sell your stock, whatever it is, and you put it in the opportunity fund. This is the investment vehicle for the opportunity zones, and it's got to be held for 10 years. Your original gain, right? So I've got some gain. I'm going to put this in the opportunity zone. It's deferred until December 31, 2026. And this is very important. There is no capital gain on the profit from the fund investment. So there's a two stack here. The first stack is what you put into the qualified opportunity zone fund. That tax deferral ends December 26, 2026, or December 31, 2026. And then the gain on top of that is deferred or is taxed. The gain is tax-free if it's held for 10 years. So the new tax incentive, this is complex. You know, I will say I saw something recently, then we're going to be discussing this in, I believe in a couple of weeks. But if you can only defer the gain until December 31, 2026, and the investment lasts 10 years, like how does that work? Where are you going to get the money to pay your taxes? Well, there is oil and gas has been combined with your qualified opportunity zone, meaning the oil and gas development happens in an opportunity zone, which a lot of places where oil is drilled, they are opportunity zones anyway. And it's structured in the way to get you not only capital gains tax benefits, but income tax benefits, generate income, and kick out enough money to pay your tax that it would be due on the capital gain in when the qualified opportunity zone ends in December of 2026. And for more information, you can reach out to Ascent Wealth Management. Again, we'll be covering this. This is kind of a newer offering, so this is something that we're looking at with clients. But I wanted you, if you're watching this, to know that the qualified opportunity zone combined with oil and gas is kind of an interesting new spin on things. Let's look at the 1031 exchange. So what is a 1031 exchange? What we're talking about here is real estate, and we're talking about selling real estate and investing the proceeds in another property and deferring your capital gains tax bill, right? So it's a like-kind exchange for business or investment real estate. So you could sell a multifamily and buy a commercial or industrial property. You don't have to buy, if you sell one duplex, you don't have to buy another duplex. This has just got to be investment property. This defers taxes, and you're using the proceeds from the sale to purchase more property. A lot of guidelines are out there on a 1031 exchange. This is a biggie. And if you miss this, you're not going to like it, because you'll end up with a tax bill. You have to go through a qualified intermediary. A qualified intermediary is not you. It's somebody else who holds on to the money, right? 100% to qualify for 100% deferral, 100% of that money. So you sell your property, escrow asks you, hey, where do you want the check? Where do you want the money wired to? If you say wire it to my own account, you're not going to be able to do a 1031 exchange, right? It's got to go to a qualified intermediary, and must be a like-kind exchange. And if you have debt on your property, I would say in general, people are buying more expensive properties, taking on more debt on the properties. And if that's not you, if you're like, oh, I just want to get off the, get off the bus, then maybe this isn't for you. But typically what we see in most deals is you are having to kind of go up, if you will, in a bigger property or more debt. So Abel buys Greenacre in 1994 for $375,000. Property's fully depreciated. What does that mean? Well, it means that over 27 and a half years, this property's been depreciated. The structures and the non-dirt aspects of the property fully depreciated to zero. Cost basis is now 100. Abel sells Greenacre and buys a replacement property, Redacre, for same price. No capital gains tax because the sale and the $475,000 in taxes are deferred. So Abel dies. Baker inherits from Abel. Baker can sell Redacre for $1.375 million tax-free. Right? So really important. This is the sort of cost basis at death, cost basis adjustment at death. If you're married, then if it's a spousal situation, right? If Baker's married to Abel, then Baker can sell that property free of any capital gains tax. So the alternative is selling it before somebody dies, potentially paying the tax. All right. So there are two stopwatches. Day one, all stopwatches start on day one. You sell the relinquished property. This is it. You're going to sell property A and buy property B, right? When you sell property A, you have 45 days to identify a property. That stopwatch can start and stop and start and stop. So, meaning you identify a property like the same day, and then you look at it and you go, it's not for me. It's, the termites are just holding hands and that's keeping the structure up. And it's, wow, it's just a lot of work. I don't want to deal with that. So you let that one go, and now your clock starts again. Right. So if that was day one, and then day one, you identify your property, and day 10, you unidentify the property, that clock starts, and you have a 45 days of starting and stopping. You have to close within 180 days. That's a hard deadline. So that is the last day to close in your replacement property. You cannot ever touch the money. Okay. It has to go from the sale to your sale to a qualified intermediary to the next escrow at purchase. If you touch it, you can't do it. So a qualified intermediary enters into a written agreement with you, the investor, and the relinquished property buyer. And the transfer or replacement property goes to you on an exchange agreement, holds the proceeds. Qualified intermediaries, by the way, this is a completely 100% unregulated space. So I would go with a reputable qualified intermediary. And, anyone can be a qualified intermediary, but I wouldn't trust anyone with a lot of money, right? So there's some other little rules, the 3 property rules. You can identify up to 3 properties of any price anywhere in the U.S. 4 or more properties can be identified if the combined value of all properties does not exceed 200% of the properties sold, and the 95% rule, which allows identification of more than 3 properties if the fair market value of the properties actually received by the end of the exchange period is at least 95% of the potential replacement properties. So I think you can see that, you really do need the experts who understand this. And this is something that is typically handled using the intermediary and the escrow. But just understand there's some rules out there, and you really do have to be, you have to pay attention. The new asset value must be greater than the relinquished property. Otherwise, you're subject to a little bit of tax. The cash invested must be greater, and the debt must be equal to or greater to, and the debt on the replacement property must be equal or greater to. Just some general rules. This requires your A-team, your realtor, your qualified intermediary, title company, CPA, lawyer, financial advisor, and mortgage lender, all these people working together. That's me. I just added myself to the picture of the A-team from the 80s, and I'm holding my book, Savvy Estate Planning, What You Need to Know Before You Hire the Right Lawyer, which is a great book about estate planning, really wherever you are in the world, because we don't even really cover, it's really designed to cover Anglo-American law, but if you're in Australia, we have people buy this book in Australia because these are basic concepts that are throughout the English-speaking world that are typically available throughout the English-speaking world. So capital gains, what about a reverse 1031? Abel buys Redacre first and then has 180 days to sell Greenacre. Abel must not only use a qualified intermediary, but an exchange accommodation title holder to hold the title of the replacement property for the duration of the exchange period. The underlying agreement is called a qualified exchange accommodation arrangement. So a reverse 1031 exchange. You buy the replacement property first. You're under that 180-day period, but this is just sort of getting into the weeds on what a 1031 is. Now let's talk about charitable trust. So this is a way to defer capital gains tax. and maybe pick up an income tax benefit. So what is a charitable trust? I want you to empty your mind a little bit. You know, if you've been watching my videos, a little bit of a yoga exercise, I suppose. You need to, we've talked about trusts a lot. This is a different kind of trust. Many times when we talk about trusts, what we're talking about is you are setting up a trust for, your children or your loved ones, or it's your living trust. A charitable trust is a really different vehicle. First of all, it's an irrevocable trust. And I like to think of charitable trusts as a tax-free zone, meaning there's a charitable trust. It's like a bucket, right? And whatever goes in this bucket, you can buy and sell and buy and sell and buy and sell. You can do all sorts of stuff. There's no tax, right? So, and we'll have some examples here on what sort of things you can put in. But when you put something in there and then sell it, there's no immediate tax, right? So this is a great place if you are, in buying and selling a lot of securities and creating wealth. It's actually really a good wrapper to put around that, because you're not going to have this sort of capital gains, short-term and long-term capital gains tax, on every single transaction for the full amount. A charitable trust is fundamentally something called a split interest trust. What does that mean? Well, you split what goes in. So if you put a thing in there, you're going to keep an interest in part of that, right? And a charity is going to get part of that. You, if you're the creator of this thing, the donor, you can be the trustee, but you don't have to be the trustee. A charity must receive 10% of whatever is contributed into that trust. A charity has to get it at some point in the future. There's effectively a net present value calculator. So there's a lot of math on this. But essentially, in order to be a charitable trust, a charity has to get 10%. Now, 10% is not much. That means 90% can go to you. 90% can go to your family. 90% can go to your loved ones. This is a phenomenal vehicle, if done right, to defer capital gains taxes. And again, we'll have some examples. This can be for a term of years or for life of a human, not any other living creature, but so either, 20 years or for my life, whatever it might be. And you get a current income tax deduction. It's very important, a current income tax deduction of the net present value of the gift to the charity. So if a person puts in $100,000 into a charitable trust and the charity is going to get 10%, that person would get a $10,000 income tax deduction, even though the charity might not get that money for 40 years, right? This is age and interest rate dependent, meaning the age of the person who is receiving a benefit from the trust, and interest rates affect the deductibility and how much a person gets. So let's look at an example. Abel, age 60, conveys Greenacre to a charitable remainder unit trust. Abel will defer. This is the $1.375 million property. Abel will defer the $487,000 tax bill, and instead of getting $888,000 today, will receive a stream of payments over a 10-year period totaling $1.633 million. Pick up a $137,000 charitable deduction, and at the end of the 10-year period, the charity gets $319,000. Since Abel's retiring and his taxable income is lower, the total tax paid is significantly reduced. Abel takes advantage of something called tax bracket arbitrage. So here's what this looks like. Year one, the rental goes into the charitable trust. It is sold. There is no immediate tax paid. Abel's payments in the first year are $289,000, the second year $249,000, $215,000, and so on. And what Abel is able to do is take advantage of the lower tax brackets and avoid some net investment income tax. So again, this is when he's at a lower income year. And this is an example so that you can understand what we're talking about. What is a charitable trust? A charitable trust is where you put something into the trust and get something back. A charity has to get at least 10%. And this can be a very effective and powerful tax deferral vehicle. So what if it's a residence? So Abel buys Greenacre for $375,000, and now it's worth $1,370,000. It's gone up $1 million. And what can you do? So a lot of people, they say, Jim, this Internal Revenue Code Section 121 exemption allows me to exempt $250,000 of gain on my personal residence if I'm single, and $500,000 if we're joint filing. What are some strategies that can be done? All right. Now, one strategy is to sell it and pay tax on the, you exempt $500,000 in gain, assuming Abel's married, and or in here, then this example, he's not married, so $750,000 gain and $278,000 in taxes. One option is to pay the tax. But if you're just going to pay the tax, you're probably not watching this video. So what are some options? Pay the tax, but Able wants more options than simply paying the tax. Rent the house for 2 years and then do a 1031 exchange. So renting the house for 2 years, it's on your 1040 as a rental. In the third year, but before the fourth year, sell the home and effectuate a 1031 exchange. You can pull out your $250,000 Internal Revenue Code Section 121 exemption, cash effectively, buy a replacement property through a 1031 with the rest. And maybe, maybe can Able move into the rental in a couple of years? Maybe, if this is all planned out and structured. This, we've covered this in other videos. Is this a step transaction? Potentially. Could the government compress all these? Yeah. This is a way of having a home, a residence with significant appreciation. You turn it to a rental and then you 1031 it, and you might be able to take out some of that 121 exemption. It's basically the amount that you can leave. You can take out tax free from the sale of a home of 250,000 if you're single. So the numbers have to work out. The timing has to work out, and who knows what the future will bring. If you move out of your house now, what will the real estate market be like in 2 years? I don't know. It's gotta work. This actually came. This is, I think, it's a pretty bad idea. One of my clients, who's a real estate investor, did this. Able conveys title to other family members as joint tenants, so it's not a change in ownership. So if Able conveys to Able and his 2 kids, not a change in ownership as joint tenants. But it is a gift, so you do have to. You're going to have file your Form 709. Each person's on title as long as each person has lived there 2 of the last 5 years. Each person can exempt 250,000. Right? That's probably a really bad idea because you're putting other people on title. You lack control. Their creditors can come after it. But in some cases, potentially, I could see people using this. So again, I'm not recommending this. This is not really something we're doing in our firm. It's just something a client mentioned to me and I thought was kind of interesting, but realistically for most people, probably a terrible idea. Managed portfolio. Able 1031's Green Acre into a managed portfolio of properties. What is this? So this is where you get what we call mailbox money. So Abel's tired of leaky faucets and plugged up toilets, and I don't want to deal with this stuff anymore. I'm going to go on my boat, go fishing, and someone deal with it. 1031 Green Acre into a professionally managed portfolio of properties. Able is able to defer taxes and gets regular checks in the mail. All the work is handled by professionals, and he can buy as much or as little of the pooled investment as fit his needs. So maybe he takes out, you do a 1031 exchange and put 90% in and maybe take 10 out and pay the tax on that 10, whatever it is. This is, if you're interested in this, this is something that Ascent Wealth Management can certainly help you with. And it's something that we bring up with people when they come in to meet for estate planning, right? Because when people come in, we ask you, hey, if you could sell property and not pay capital gains tax, would you want to do that? A lot of people say, yeah, my depreciation's gone, or I'm tired of it, or whatever it might be. This is an option that some people find attractive. And then there's the other, if you own a business and the business owns a piece of property. So Able and Baker are married and own a business that rents property owned by 123 Main Street or Main LLC. So the idea here is Able and Baker own the property. They have a business on the property that they own. It is in an LLC, so it's protected. You want some creditor protection there. And that property that Able and Baker own is in an LLC, taxed as a partnership. When Able dies, Baker gets a full adjusted cost basis. So Baker can sell that property free of capital gains tax. This has to be done on the partnership return level, typically in the year of death in that tax year, on the Form 1065. And you really want to be careful. Not all CPAs catch this. If this is you, if you've lost a spouse and you've got an LLC taxed as a partnership, you definitely want to pay attention to this and make sure that it's literally checking a box and some other stuff. So, I mean, there's more work than that, but you have to check the box. So deferring capital gains with retirement planning. Well, what are we talking about here? Well, your IRA, 401k, Roth, 403b, TSA, tax sheltered annuity are all tax deferred accounts. That's what we mean by qualified accounts. And buying and selling assets in these accounts is not a taxable event. When the assets are distributed, you have to pay income tax, right? Higher than capital gains. But the Roth IRAs and Roth 401ks allow for tax-free distribution. So working with your A team, you can maximize your tax benefits. Because you may want to have the trading activity. This is where you want to look at your overall portfolio. If you have non-qualified assets, which are assets that are not qualified for tax deferral, you may want to treat those differently. If you're buying and selling securities than if it's in your retirement account. So looking at both of those, you may actually find more trading activity in your retirement account than your non-qualified account. So it's something you'd want to work with your A team on. Let's look at the installment sale. An installment sale is an asset is sold, but instead of receiving the full sales price up front, you get payments over multiple tax years. This allows you to spread out the recognition of your capital gains over time, and this can reduce your tax bill, right? When you look at multiple years together, you might be better off. This works with real estate, closely held corporate interests, LLC, partnership, and corporation, and collectibles. Does not work with publicly traded securities like Apple, Google, Nvidia. So here's how the tax works. Your gain is your sales price minus your adjusted basis. Now, what is adjusted basis? Adjusted basis is what you paid for it, plus improvements, minus depreciation. So if it's real estate, you might have some depreciation in there or some other assets. Gross profit percentage is your gain divided by sales price. We have an example on here. Your taxable portion is the cash received times your gross percentage, and the rest of the payment is tax-free. So if you have basis in the thing that you're selling, when you receive those payments, some is taxable, and some is tax-free. So Able buys Blue Acre for $1 million with an adjusted cost basis of $400,000. The gain is $600,000, so it's $1 million minus $400,000. The buyer pays $200,000 down payment and payments over the next 5 years. Able's gross profit percentage is 60%. So in the first year, when Able gets his $200,000 down payment, Able's taxable gain is $120,000. So it's 60% of the payment received. So it is spread out over time. That works for some people, doesn't work for other people. You know, a lot of people are nervous if this is the person you're selling to who's making the payments. You're like, well, is this person going to pay? Sometimes you can go to a third party who holds the money. There are a lot of ways to do this, and it can be beneficial, but there are some other strategies as well. But I did want to cover this because people do ask about it. Qualified small business stock. Qualified small business stock, if you have it, kudos to you. These are certain. What is qualified small business stock? It is a tax designation for stock of some small domestic C corporation. So corporations taxed under subchapter C of the Internal Revenue Code. Qualified small business stock held for more than 5 years and sold can be eligible to be excluded from capital gains tax. So this excludes 100% of the gain. It is the greater of 10 million or 10 times your basis. It's going to be important in another example. So the greater of 10 million or 10 times your basis. This is, for founding or investing in and working for a startup. It's riskier. The government rewards. We see this a lot in the tech space. And the QSBS exclusion can help people. It's basically a reward to take risk and build American companies. It's under Section 1202 of the Internal Revenue Code. So example here is Able invests $25,000 in ABC Corporation, which is a qualified small business. He holds for 5 years, sells that $25,000 grows to $10 million, and it is 100% excluded from federal capital gains tax. Baker invests $50,000 in ABC Corp. It's the same company, and holds it for 5 years and sells for $20 million. He excludes 100% of the $10 million from capital gains, but the other 10 is subject to capital gains tax. And this is where this leads us into what can Baker do to pack or stack his qualified small business stock? Well, this is an example of packing. So Baker can invest additional cash or property. If it's property valued over $1 million, this is like actual property, right? Into the qualified small business stock issuing company in exchange for more stock. So this bumps up your basis because the contribution is valued at its fair market value when the stock is issued. So we're going to give an example of this. You can sell your high basis QSBS in the year. You sell your low basis QSBS, right? So if you own some high basis QSBS, you can sell these alongside your lower basis because they look at the aggregate of the QSBS, the qualified small business stock, sold in a given tax year. So it's important to pay attention. If you have more than one qualified small business stock investment, you're going to be looking at those, and it might make sense to sell some of the higher basis with the lower basis because it can maximize your benefit. So here's a packing example. Able owns land with a basis of $1 million. It's worth $5 million. Able exchanges the property for $5 million worth of QSBS stock. Able realizes a $4 million gain. So he's going to realize a gain on the $4 million, but Able's basis in the qualified small business stock is now $5 million. Able can exclude gains up to $50 million. So what he's done is because he's added more money, he can get a 10x multiple on his qualified small business stock exemption. So in this case, he's able to exempt $50 million of gain because his basis is 5 million and you can exempt up to 10x of your basis. Okay. So if you didn't quite get this, hit the rewind button and look at it again. The other one is stacking. So stacking QSBS is multiplying your exclusion limits by involving more taxpayers. So one is by adding more capital to a company, and then the other one is taking your existing shares and spreading those among other taxpayers. So this is strategically gifting qualified small business stock to family members or non-grantor trusts, and each person must be a separate taxpayer. We see these a lot of incomplete non-grantor trusts. Now, this doesn't work for California state income tax because, by the way, if you're a California resident and have QSBS, you're going to be subject to California income tax. So you're not subject to the federal, but the state, yes. So we would use a non-grantor trust, and in California, we would be using a complete non-grantor trust. But we're talking federal only. So ideally, you want to make these gifts when low to minimize your transfer tax. So stacking pulls at a thread of a very complex sweater and can have tax implications beyond just the qualified small business stock benefits. So if you invest in 200,000 in a startup and the company becomes successful and you sell your shares for 15 million, you're going to have a bit of a limitation on there. So there's a limit. So let's look at an example. Abel invests 25,000 into ABC Corp. Abel is in a very generous mood. So he just invested 25,000. He creates 5 non-grantor trusts in Nevada, each trust holding $5,000 in qualified small business stock. One trust is for Baker, Abel's spouse, and one for each of their 4 children, Charlie, Delta, Echo, and Foxtrot. When the stock sells for 50 million, the entire gain is tax-free. It's in Nevada, not subject to California income tax. These can be written as 365-year dynasty trust under Nevada law. So poof, with a little bit of forethought and planning and vision, Abel is able to use the existing tax code to not only avoid transfer tax, but get these into trusts that are for each of his children and spouse, and great tax benefit. Well, if Abel's not feeling so generous, if he's feeling a bit scroogey, he can create 5 charitable trusts, each holding 5,000 in qualified small business stock. When the stock sells for 50 million, the entire gain is tax-free. Abel gets payments, 10% of the original gift, or 2,500 goes to charity, right? This could be one structure. Abel keeps 99.9995% of the benefit without paying federal income tax. So if that's interesting, if this is you, we should be talking. Do married couples get 10 million each? Well, 2 things. One, Section 1202 was written kind of poorly, shocker. And there's a case from 1946, the Levy case. You are probably not going to get double up on your $10 million exemption. If you're married, it's going to be 10 million per person. Although if you're single, each single person gets 10 million. This probably is the single biggest marriage penalty in the Internal Revenue Code. And this, by the way, can be a reason that people become registered domestic partners in California. So if you're investing in tech and, it's community property in California, there's a use case here for not being married and being a registered domestic partner to skip this massive marriage penalty. Well, that brings us to the end. I hope you've enjoyed our time here together. We have office locations in Auburn, Oakland, Sacramento, San Francisco, San Rafael, and Walnut Creek, as well as Pasadena and Westlake Village. If you're watching this on YouTube, please subscribe to our channel. And these come out every Thursday at about 6 p.m. Pacific time. And next up, on March 21st, the first day of spring, when should you have a comprehensive financial plan? I will have certified financial planners from Ascent Wealth Management joining us. And this is a really important question. When should you have a comprehensive financial plan? Is it annually? Is it never? Is it when you're 50? Is it when you're 30? I don't know. We're going to find out. It's going to be a great time with them. We will open it up for questions. So at this time, I will, if you're watching this on YouTube, by the way, or listening to it on a platform, another event or another video is going to roll up right after this one. So just stay watching. Don't go anywhere.